Welcome to the Deep Dive. Today, we're plunging into a story that, well, on the surface, might seem to be about a quiet, maybe even sluggish American housing market.
Hmm.
But beneath that calm exterior, our sources reveal a powerful and somewhat paradoxical dynamic that's fundamentally reshaping the competitive landscape. This isn't just another predictable downturn. It feels more like a strategic chess match playing out in real time.
Yet what's truly fascinating here is how the very economics forces that are suppressing demand
Mm.
are at the same time carving out this unique and pretty powerful opportunity for new home builders.
Really? How so?
Well, it's a classic case study,
Yeah.
how market leaders don't just sort of weather significant headwinds, but actually transform themselves to capture market share.
Okay.
So our mission in this deep dive is to extract the most important nuggets of knowledge, the insights from recent market analyses, a detailed look at Lennar Corporation's financials, and this intriguing spin-off revelation. We want to understand precisely how this titan of American industry is navigating these, let's face it, challenging times by basically reinventing its core business model. You're going to see a company betting big on a very different future.
Okay, let's unpack this then. The housing market often feels like it's just about rising or falling interest rates, right? A fairly straightforward economic equation for most
It's we,
people.
yeah.
But our sources today paint a much richer, more intriguing picture, especially when it comes to a giant like Lennar and their, well, audacious strategic moves.
Indeed. And to really understand Lennar's play, we first need to get a handle on this strange quiet that's currently dominating the housing market.
Strange, quiet. I like that description.
The primary culprit here is persistent mortgage rates. They've been flirting with that 7% mark, as of June 2025.
Ooh, 7%.
Yeah. And for the average family, these rates are truly crushing affordability. Think about it. Even a seemingly small increase in interest rates can add hundreds, maybe thousands, to a monthly mortgage payment. This is leading to remarkably sluggish sales of existing homes. I mean, sales that are, quite frankly, a pale shadow of their pre-pandemic figure. It's a stark indicator of the pressure on would-be buyers.
And it's not just about what new buyers can afford, is it? There's this massive lock-in effect happening too.
Exactly. Explain that.
Well, imagine a kind of financial golden handcuff binding a huge chunk of American homeowners. They're sitting on mortgages locked in at rates below 4%, many of them way below that.
Right, those sweet 3% deals.
Exactly. So for these millions of homeowners, the mere prospect of selling their current home, where they have this incredibly affordable payment, and then moving into a new property with a 7% mortgage, well, it's utterly unpalatable, to put it mildly.
Who would do that?
Right. Who would willingly double their interest rate overnight and see their monthly payments skyrocket, maybe for the same size house or even a smaller one?
Precisely. And this lock-in effect has had a profound impact. It has effectively starved the resale market.
Starved it.
Yeah, it's created a significant vacuum of available properties. Now, while we are starting to see some inventory tick up in certain areas, giving buyers a bit more choice,
Okay, a little bit.
it's crucial to understand that this new supply is not, by and large, coming from traditional sources. It's not existing homeowners suddenly deciding to sell like crazy.
So where is it coming from?
Well, the market's essentially frozen at the high end, mostly. It's only those facing major life changes, job relocation, family getting bigger or smaller, who are truly motivated to make that move and swallow the higher rate.
So, okay, we have this hugely constrained existing home market. But at the same time, there's this persistent underlying supply shortage of homes overall, right? Across the country.
Oh, absolutely. We're talking about a chronic deficit. The numbers vary a bit, but roughly 4 million homes nationwide.
4 million, wow.
Yeah, this shortage largely stems from years of underproduction. It's a direct legacy of the post-2008 housing crisis. New construction just fell off a cliff back then, and for over a decade, it never really fully recovered to meet demographic demand.
We just didn't build enough.
I simply haven't built enough homes to keep up with population growth, household formation, all of that.
So even with that glaring deficit, you're saying new construction has struggled to really fill the void. Why is that?
Well, builders have been cautious,
Hmm.
often pulling back because the demand signals are mixed. It's a really complex picture on the ground.
Okay.
You have restrictive land permitting processes that add significant delays and cost sometimes years to get a project approved.
Bureaucracy?
Yeah, and then there are higher impact fees levied by local governments. That adds to the cost of every single new home. And then the familiar headaches,
Yeah.
increasing labor and material costs, just persist.
The lumber headache. I remember.
Exactly. Lumber has been a particular pain point for years.
Mhm.
And while it's come down from its absolute peaks, it, along with other materials, just keeps adding to the overall expense.
Yeah.
It makes it harder and harder to build at a price point that makes sense for the average buyer.
And it's not just economists talking about this either. We see real-world examples. Didn't you mention the governor of Utah?
Yeah, Governor Cox in Utah, he's been actively campaigning for more supply, especially affordable starter homes. He described a whopping 350,000 home deficit in his state alone,
Just in Utah.
just Utah. And he's even pushing to eliminate or modify restrictive zoning restrictions, things like those that mandate huge lot sizes or prohibit multifamily dwellings, just to try and get more homes built faster and more affordably.
That really highlights the scale of the problem, doesn't it? It shows it's a top-of-mind issue for state leaders, not just, industry insiders.
Absolutely. And yet, despite these significant supply constraints and the affordability challenges, the underlying demand absolutely persists.
Okay.
We have strong demographic tailwinds, particularly from the millennial generation. They're hitting their prime home buying age now. They still want homes. They need homes. The aspiration for homeownership hasn't vanished.
But they can't afford them.
Well, that's the conundrum, right? Demand is fundamentally high, but affordability issues and, frankly, waning consumer confidence are sending what management or Lennar themselves describe as confusing signals to the market.
Confusing signal.
Builders are trying to figure out how much consumers can truly afford and, at what pace homes will actually sell if they build them.
So if we pull all that together, what does this current housing market really look like? We have a market that's cooling, but maybe not crashing like some expected.
Exactly. Cooling, not crashing. But it's driven by this fundamental supply and demand dynamic that remains totally unaligned,
Unaligned.
which leads to stubbornly high prices that, despite everything, continue to lock out potential buyers. It creates this strange kind of equilibrium,
So the market desperately needs supply,
desperately.
but it needs it at a cost structure that people can actually afford. And that, right there, that's where Lennar is making its big bet. They think they can solve that paradox.
That's exactly it. They believe they can be the solution. And if we connect this to the bigger picture, this isn't just a typical cyclical downturn like we've seen before.
Okay.
It's a fundamental reshaping of the competitive landscape. The macroeconomic headwind of high interest rates has paradoxically created a structural tailwind for the large integrated players like Lennar.
Wait, how does that work? A headwind creates a tailwind.
Because the resale market is effectively paralyzed by that lock-in effect we talked about.
Right.
These big builders are uniquely positioned to provide the available homes that the market desperately craves. This structural shift allows them to scale up and gain market share in a way that just wouldn't be possible in a normal free-flowing market where used homes compete effectively.
Okay. That's a powerful insight. So to truly understand Lennar's audacious strategy and how they plan to capitalize on this, we need to quickly dig into the different business models within the home building industry itself.
Good idea.
It's important to define home builders, not just as people laying bricks and hammering nails, right? They're more like master orchestrators.
That's a great way to put it. Orchestrators.
Mm.
They bring together all the complex pieces, the land, the design, the permits, materials, labor, financing, sales, everything needed to design and construct new homes, and sometimes entire neighborhoods from scratch.
Okay, so what's the traditional way?
Traditionally, there's been what we call the standard or capital-intensive model. In this approach, home builders go out and purchase vast tracts of raw land, often years before they plan to build on it.
Years in advance.
Often, yeah. They then hold these parcels, sometimes for a very long time, as inventory on their balance sheet before they even begin the process of developing them for construction.
So lots of money tied up.
Exactly. The key challenge with this model is its significant upfront capital requirement. You have billions of dollars tied up in land, effectively dormant, unproductive. And this exposes the company to immense risk if land values collapse, as we saw so vividly during the 2008 financial crisis. Builders holding vast land portfolios saw their balance sheets just decimated.
Right, I remember that.
Historically, giants like D.R. Horton, Pulte Group, and even Lennar itself operated predominantly under this very model. They were, in essence, land speculators almost as much as home builders.
Okay, so that's the old way, the risky way. What's the alternative?
The alternative is the land option, or capital light model. This approach is significantly more flexible and, well, like the name says, much less capital intensive.
How does it work?
Instead of buying land outright, builders secure an option to buy it later. Think of it like putting down a small deposit to reserve a piece of land, but you're not obligated to actually buy it until you're truly ready.
Okay.
They only exercise that option, meaning they actually purchase the land after a home buyer has committed to purchasing a house on that specific plot.
Ah, so they line up the buyer first.
Pretty much. This drastically reduces the amount of dormant capital tied up in land inventory, and critically, it minimizes exposure to that speculative land risk.
So if the market tanks,
If the market turns south, they can simply choose not to exercise their options. They might lose their small deposit, but they walk away from taking a massive write-down on land they would have owned.
that sounds way smarter, especially in a cyclical industry.
It is. NVR and Dreamfinders Homes are often cited as pioneers in this asset-light approach, and their history during the last housing downturn is particularly telling.
Oh, yeah.
NVR, for example, showed remarkable resilience and profitability during the 2008 crash precisely because of this model. While other traditional builders were sinking under the weight of depreciating land assets, facing massive losses, even bankruptcy,
Right.
NVR could just choose not to exercise its options on unbuilt land. They avoided those heavy losses. It allowed them to stay profitable, which was almost unheard of then. It's a testament to the power of minimizing land risk.
Okay, so how does this industry's cyclicality fit into the picture more broadly? We know home builders are cyclical, their fortunes tied to the economy, interest rates.
Yeah, it's widely known. Inherently cyclical. Strong economy, low rates, sales and profits usually soar.
And slowdowns.
Slowdowns, rate hikes.
Yep.
Builders cut back on new projects. Cancellations increase. It's a predictable ebb and flow, makes them a very sensitive barometer of the economy.
You're saying the model matters here.
Right. What's important to emphasize, linking back to those business models, is that the land option model companies are inherently less cyclical.
Less cyclical. How?
Their ability to simply not exercise their options when demand drops allows them to avoid the heavy losses associated with owned land. It provides a fundamental cushion that traditional land-heavy models just don't have. They can contract quickly and efficiently without that burden of depreciating assets.
Okay, so we've painted a picture of a really weird housing market, kind of frozen, but with underlying demand. And we've explored these two main business models for builders, the land-heavy traditional one and the asset-light option model.
Right.
So how does a company like Lennar, historically a titan of that traditional land-heavy model, intend to pivot and thrive in this unique and challenging environment? That's where their audacious gamble comes in, you said.
Exactly. This is the core of the story. Our sources reveal they're not just tweaking their strategy, they're undergoing a profound, almost revolutionary transformation of their very identity.
A revolution
Yeah.
for a giant like Lennar.
It really is. And this raises a huge question. Can an established industry giant, deeply rooted in the standard capital-intensive model, successfully execute such a fundamental pivot to become truly asset-light?
Yeah, can they change their DNA?
That's what they're trying to do.
Yeah.
Lennar's audacious move, particularly with the Milrose property spinoff, is a bold, multi-billion-dollar attempt to answer that question. It's a strategic imperative for them. They want to evolve from what they've called a capital-intensive land baron
Land baron, I like that.
to a pure-play, asset-light, new home manufacturing company, shedding what they clearly see as the most cyclically treacherous part of their business, owning all that undeveloped land.
Okay, so the centerpiece of this transformation, the real headline grabber, is this Milrose property spinoff. That happened, what, February 2025?
February 7th, 2025, yeah. And this wasn't just a minor reshuffling of assets. It was a colossal transaction designed to fundamentally change Lennar's balance sheet.
How did it work?
Lennar spun off the vast majority of its land holdings into a new, separate, publicly traded entity, Milrose Properties, ticker MRP.
Okay, a new company.
Then, Lennar distributed 80% of Milrose shares directly to its existing shareholders. So if you own Lennar stock, you suddenly also own shares in this new land company.
Yeah.
Lennar itself kept a strategic 20% stake.
Okay, so they still have some skin in the game, but most of it is now owned by the public or Lennar's old shareholders.
Exactly. And the core mechanism here, the engine of this new model, is what they call their home site option purchase platform, or HOPPR.
Whole PPR.
Catchy. Milrose gets this platform, and moving forward, Milrose will develop land and then provide it to Lennar on a just-in-time basis.
Just-in-time land? Like manufacturing.
Precisely.
Yeah.
So Lennar will now primarily purchase options to gain control of home sites rather than buying the land outright and carrying it on its books for years.
Wow. So how much did their land ownership actually change?
Dramatically, swiftly. They slashed their own home site supply from, get this, 1.3 years worth down to a mere zero point 0.2 years.
Whoa, from over a year to barely a couple of months.
Yeah. To put it another way, they now control a staggering 98% of their future land needs through these flexible options and other agreements, rather than direct ownership. This fundamentally changes their exposure to land risk. It's huge.
That is a truly massive radical change for a company of Lennar's size and history. So, okay, what are the strategic gains for Lennar itself for making such a bold move? Why do this?
Well, first, and perhaps most importantly, there's a huge boost in capital efficiency and cash flow.
Makes sense. Less money tied up in dirt.
Exactly. This move significantly lowers Lennar's capital costs.
Hmm.
Imagine billions of dollars that were previously dormant, just sitting there, tied up in unproductive land inventory. Now, that capital is freed up.
So what can they do with it?
Well, they can strategically redeploy it. Things like aggressive share buybacks, increasing dividends to shareholders, or even making strategic acquisitions that align with their new asset-light vision.
Okay.
Plus, by reducing land ownership, it's expected to better align their net income with their free cash flow. That gives investors a clearer, maybe more accurate picture of their operational performance, not muddied by land value swings.
And what about the risk aspect? That seems key.
Oh, absolutely critical. Risk transference. With this spin-off, Milrose shareholders, rather than Lennar shareholders, now primarily bear the risk of land value fluctuations during a downturn.
So if land prices crash like in '08.
It's Milrose shareholders who take the hit, not Lennar directly. It creates a significant layer of insulation for Lennar, protecting it from potentially catastrophic losses tied to depreciating land assets, the Achilles heel of the old model.
So better cash flow, less risk. What about profits?
Well, this asset-light strategy is specifically anticipated to boost Lennar's profitability, and, crucially, its return on equity is a key metric investors watch.
Right, ROE.
By reducing the assets on its balance sheet, Lennar expects to enable stronger margins eventually, achieve better inventory turnover, and maintain a stronger balance sheet compared to peers like NVR, which has historically shown a much higher ROE precisely because of its land-light model. They're aiming for that NVR-style valuation.
Okay, now this all sounds like a brilliant, game-changing move for Lennar, like almost too good to be true. But our sources also highlight a pretty controversial structure to this Milrose deal, particularly from the perspective of the new MRP shareholders.
Ah, yes. The other side of the coin. It's definitely not straightforward.
For instance, Milrose is structured as a real estate investment trust. That's unusual, isn't it? Home builders typically can't be REITs because they actively buy and sell property, which doesn't fit the usual REIT model of stable, long-term real estate income.
Correct. It's a bit of financial engineering. Lennar and Milrose seem to have found a workaround. There's a massive $4.7 billion loan from a Lennar land holding subsidiary to the REIT at 7.5% interest.
A loan from Lennar to Milrose.
Essentially, yes. This structure seemingly cleanses the income Milrose gets from eventually selling lots to Lennar, making it look like stable interest income for the REIT, thus making it REIT compatible for those tax benefits. It's clever, but complex.
Okay. In the terms of this arrangement, one source described them as awful for Milrose property shareholders.
That's strong language, but yeah, the terms are very favorable to Lennar. Lennar essentially secured what amounts to a permanent 80 to 90% loan-to-cost, or LTC, financing facility for its land development needs.
80 to 90% financing from Milrose.
Yes, at a rate that starts at 8.5% and can vary between 7 and 10%. This is described by one source as a rate that's far more generous than any typical commercial lender would ever give. From Lennar's side, it's remarkably cheap and flexible financing for acquiring and developing its raw material land.
Wow. And it gets even more interesting when you look at Lennar's equity at risk in these deals, right? How much of their own money do they put in?
Very little, relatively speaking. Lennar contributes only a 5% deposit on total land and horizontal development costs initially, with maybe a second 5% later. So they're effectively putting only 10–20% equity at risk on these land parcels.
Okay, and here's the kicker for Milrose shareholders, as I understand it. Milrose receives fixed monthly payments, sort of like interest on that loan,
Right.
but they receive zero upside from any land value appreciation. Is that right? They have to
Yes.
sell the finished lots to Lennar at cost.
That's the crucial point. Exactly. Imagine buying a piece of property, spending money to develop it, improve it, get it ready to build on, and then being forced to sell it back to the original owner at the same price you bought the raw land for, regardless of how much its market value has increased.
So Milrose takes on the development cost and risk, but gets none of the potential land profit?
Correct. Milrose simply acts as a financier and developer for Lennar with no participation in the profit on the underlying land itself. It's purely a fee-for-service model, essentially.
Wow. That source describing Milrose as a captive entity seems pretty accurate then. Like, it essentially has to accept any deal Lennar brings to them.
That's the portrayal, yeah. Because Lennar holds that significant 20% stake and controls the HOPPR platform, the argument is Milrose doesn't have much negotiating leverage.
And there are other concerns too, right? About who controls getting the land ready, the entitlement process.
Yes, there are worries about Lennar's control over entitlement and pricing. Lennar seemingly controls the whole entitlement process, getting land rezoned and approved for building, which is often where a lot of value is created.
Okay.
This raises concerns that Lennar could bring unentitled, cheap parcels to Milrose, have Milrose buy them at that low, unentitled value, pay Milrose to develop them, and then buy the finished, entitled home sites back from Milrose at that same original, unentitled value.
So Lennar avoids all the cost and risk of getting the land approved and captures all the value uplift.
That's the concern highlighted by the source. Yes, Milrose bears the cost, Lennar gets the benefit.
And as if that wasn't enough, Lennar has some sort of right to just stop paying.
Well, not stop entirely, but they have a unilateral right to have payments to MRP for 6 months twice with no penalties,
Have payments, just like that.
apparently. And they have a permanent right to implement additional pause periods whenever they want. This gives Lennar an incredible amount of flexibility and control over Milrose's cash flow. If Lennar faces a slowdown, they could just dial back their payments to Milrose.
And Milrose pays a hefty management fee too.
Yes, 1.25% of assets to an external manager, which one source cynically suggests is for basically just rubber stamping Lennar's deals, rather than for active independent management looking out for MRP shareholders.
So from Lennar's perspective, why structure it this way? What's the rationale for making it so seemingly one-sided?
The implied rationale is pretty clear. Lennar's management likely believed their vast land holdings weren't being appropriately valued by the stock market when they were part of Lennar's overall company. Land assets often drag down a builder's valuation multiples.
Right, seen as risky.
Exactly. So by offloading them to this captive entity, Milrose, Lennar believes it can achieve increased margins and profits on its core home sales, generate more consistent earnings, and potentially earn a higher valuation multiple for Lennar itself as a pure-play builder.
So it's a bet on market perception and financial engineering to unlock value for Lennar shareholders.
That's the bet. A calculated gamble designed to unlock shareholder value for Lennar, potentially at the expense of Milrose shareholders.
This really highlights the dual nature of these big strategic financial moves, doesn't it? What's a game changer for one entity might be a, well, challenging proposition for another, depending entirely on how the deal is structured and who holds the power.
Absolutely. It's all about who bears the risk and who captures the upside. In this case, Lennar clearly designed the deal to capture the lion's share of the upside while outsourcing the risk.
So this kind of complex financial engineering lets Lennar outsource significant capital and risk to the public markets via Milrose.
Precisely. The fundamental question then becomes how the market ultimately values these two separate entities. You've got the new pure-play Lennar, this leaner, asset-light home manufacturing company, and then you've got the new captive Milrose entity, effectively a land bank and financing vehicle for Lennar.
Will the market value them differently? Will that create opportunities?
That's the intriguing question for investors. Does the market recognize the de-risking of Lennar? Does it understand the constraints on Milrose? That valuation disconnect, if it exists, is where opportunities might lie.
Okay, so with this massive strategic pivot underway, let's turn to Lennar's latest performance. Their second quarter 2025 results, they came out in June. Now, on the surface, the headline numbers looked, well, pretty grim, didn't they? And the market reacted that way.
Yeah, initially not great optics. Net earnings nearly halved, down to $477 million from $954 million the year before.
Ouch.
The gross margin on home sales got squeezed significantly, falling to 17.8% from 22.6%. That's a big drop.
And prices.
Average sales price dropped by 9% to $389,000. That was a clear sign they were using more incentives to move properties in a softer market.
So yeah, for many people looking at those numbers, it looked like a red flag, right? And the stock did go lower.
It did. But this is precisely where the deeper story emerges. where you have to understand Lennar's strategic intent. These seemingly grim numbers are a direct result of a deliberate strategy.
Deliberate. How so?
They chose to sacrifice margin for volume. Lennar consciously decided to price homes to market conditions and use those incentives, like mortgage rate buydowns, specifically to maintain their sales pace.
Okay.
They explicitly avoided production halts. That's a painful lesson they learned from previous downturns. They're making a calculated trade-off, lower profit per home, but keep the production lines running and sell more homes overall.
And did it work in terms of that crucial volume?
It seems so, yes.
Yeah.
Despite these challenging conditions in the overall market, Lennar actually increased its home deliveries by 2% to over 20,000 homes in the quarter.
Okay, deliveries up slightly. What about new orders? Future business.
New orders were up a healthy 6% to 22,601 homes. So future demand looks solid too. This demonstrates the early success of what they call their even flow production model.
Even flow production, where margin is the shock absorber.
Exactly. Margin acts as this shock absorber.
Yeah.
Management has explicitly stated they learned from history. Previously, in downturns, trying to protect short-term margin meant losing momentum, halting construction.
Which makes restarting hard and expensive.
Incredibly difficult and expensive. And they realized that approach prevented fundamental company change. So maintaining consistent volume now, even at lower margins, is about creating new, durable efficiencies across their entire operation. It's a long-term play.
And this consistent volume, it helps their suppliers and subcontractors too, right? Gives them certainty.
Yes, that's a huge piece of it. It provides crucial certainty for their trade partners, the subcontractors, suppliers, the skilled labor. Lennar is injecting technology-assisted solutions and is laser-focused on using this consistent volume to work collaboratively with these trade partners to reduce costs across the entire platform.
How does that work?
Well, think about it. For contractors, whether they're vertical trades like framers and roofers or horizontal trades doing roads and utilities, continuous use of their crews and heavy equipment is everything. Idle equipment costs money. Inconsistent work means losing good people.
Right.
So Lennar's commitment to steady, predictable volume creates a powerful incentive for these partners to collaborate on cost reduction. They might offer Lennar better pricing in exchange for that guaranteed stream of work. It becomes a win-win in the long run.
And are they actually seeing results from this, tangible cost savings?
They are, which is crucial. Their direct construction costs were sequentially lower by 1.5% from Q1. That's good. And they're down an impressive 3.5% year over year. They're actually at their lowest point since the third quarter of 2021.
Okay, so costs are coming down.
And that trend is expected to continue. It shows the power of that consistent volume strategy.
What about how fast they're building?
Getting faster, too. Their construction cycle time decreased by 5 days just from Q1. It's down to a remarkably efficient 132 calendar days on average for a single-family detached home.
132 days. How does that compare?
That's an 18-day or 12% decrease year over year. And here's the kicker. It's now lower than their pre-pandemic cycle times.
Faster than before the pandemic. Wow.
Means they're building houses faster than ever.
Yeah.
Plus, their inventory turn improved to 1.8x, up from 1.6x last year. That directly reflects these operational efficiencies and the asset-light land strategy. They're moving product through their system more quickly.
So operationally, things look strong despite the margin hit. What about their finances? Can they afford this strategy?
Oh, yeah. Beyond the operational efficiencies, Lennar's financial fortitude remains robust. That's critical during a strategic transformation like this. They maintain what they describe as a fortress balance sheet.
Fortress balance sheet.
Their home building debt-to-total capital ratio is just 11.0%. That's remarkably low for this industry. And they have total liquidity of a substantial $5.4 billion. Plenty of cash on hand.
So they have the resources.
Absolutely. This financial strength allowed them to repurchase $517 million of their own common stock in the quarter.
Buying back shares?
And pay $134 million in dividends. That signals strong management confidence in their long-term strategy and a commitment to returning value to shareholders, even while margins are lower.
Did they do anything with debt?
Yeah, they strategically issued $700 million in senior notes to pay off $500 million of maturing debt. Basically optimizing their debt structure,
Wow.
locking in rates, further solidifying their financial position.
Okay, so looking ahead, what's their guidance for Q3 2025? Do they expect margins to stay low?
Their guidance suggests they expect gross margin to stabilize right around that 18% mark.
Stabilize.
Yeah, indicating they think they've found their market clearing price for now and are comfortable operating there. They project new orders and deliveries to remain strong, between 22,000 and 23,000 homes.
And price.
Average sales price expected around $380,000, $385,000, so still indicating continued pricing pressure and the ongoing use of those incentives.
What about overhead costs? SG&A.
They're projecting selling, general, and administrative expenses, SG&A, to be 8.0%, 8.2%. That remains slightly higher than maybe historical norms, mainly because of those ongoing heavy technology investments they're making.
Right, the tech spending. We'll get to that. What did they say about the consumer on their earnings call? Are things still soft?
Yeah, management noted continued softening due to the higher interest rates and that waning consumer confidence. They're seeing it manifest in a couple of ways. Higher debt levels on some loan applications.
People are stretched thin.
Seems like it. And a notable shift towards more government-backed loans, like FHA and VA loans. Those increased from 40% to 48% of their volume. That often indicates buyers needing more assistance or facing tighter budgets.
And are buyers sensitive to price? Can Lennar push prices up at all?
They confirmed a constant need for real-time analysis of traffic, sales pace, and inventory to make pricing adjustments, including those incentives, to find that market-clearing price.
So constant tweaking.
Constant tweaking. There's no consistent price inelasticity across markets where they can just raise prices freely. Instead, they described it as an ebb and flow market that requires constant adaptation. It's dynamic. You can't just set a price and forget it. It requires daily, weekly adjustments based on what they're seeing on the ground.
This really highlights a company making a very deliberate, very calculated trade-off, doesn't it? Sacrificing some short-term profit for the long game, maintain market share, drive operational excellence, cement this new asset-light model. It's a calculated risk, but one they seem to be executing with remarkable discipline, especially in a market giving out all those confusing signals.
Yeah, what's truly fascinating here is the sheer discipline required to execute this production-first strategy during a downturn. It's all about maintaining that flow, that volume, and leveraging it to drive systemic cost reductions across their entire supply chain. It's turning what looks like weakness in headline numbers, those lower margins, into a foundational strength for the future.
It's like they learned from 2008 not to just slam on the brakes.
Exactly. Imagine trying to restart a massive production line after it's been completely shut down cold. That's what many builders faced after 2008. It took years to ramp back up. Lennar explicitly said on their call, they won't make that mistake again.
So it's not just about avoiding immediate losses. It's about preserving that operational momentum. Like keeping a giant factory humming, maybe at reduced output, because restarting is just too costly and too slow.
That analogy of a factory humming is perfect.
Yes.
They're optimizing for flow, knowing that consistent volume unlocks efficiencies that stop-start piecemeal production simply can't achieve.
Speaking of foundational strength and building that factory, Lennar's not just building houses differently, they're building a fundamentally different kind of company, aren't they? Leveraging every piece of the puzzle: financing, digital marketing, back-end operations. It sounds like a full-spectrum transformation.
It really is. Take their financial services segment. That includes mortgage financing, title insurance, closing services. It's truly evolved into a critical strategic weapon.
How so?
Well, this vertical integration gives Lennar a unique ability to directly attack the market's biggest pain point for consumers right now: the monthly mortgage payment.
Affordability again.
Always. They can, in their words, manufacture affordability by offering incentives like mortgage rate buydowns directly to their buyers.
Which someone selling their existing home can't do.
Exactly. It's a powerful advantage over the resale market, where sellers don't have that capability, and over smaller competitors who lack in-house financing arms. And the segment's strong performance earnings increased primarily due to higher profit per loan. It validates the strategy. It's a closed-loop system designed to capture the buyer and make the sale happen at every step.
Okay, and they are pouring money into technology. That explains some of those higher SG&A numbers we mentioned.
A lot of money. Management is laser-focused on injecting technology-assisted solutions into its entire platform. They view this as a significant investment in a differentiated future. They genuinely believe it will make the company meaningfully different and decidedly better than its competitors in the long run.
Even if it costs more now.
Even if it adds to those SG&A expenses in the short term. It's a long-term play, pure and simple.
So what kind of tech are we talking about?
Well, a prime example is something they call the Lennar machine.
The Lennar machine. Sounds intense.
It's their core digital marketing and customer acquisition product, built on a Salesforce backbone. Think of it as a central nervous system for their sales efforts.
Okay.
It ingests the data from across Lennar's vast sales landscape, website traffic, model home visits, online inquiries. This allows them to manage dynamic pricing in real time, see what's working where, and significantly reduce customer acquisition costs.
Getting smarter about finding buyers.
Exactly. And it's even evolving to include an actual agent force for quick, even off-hours customer engagement. The idea is, when someone expresses interest online, Lennar can respond almost instantly, day or night, increasing the chance of conversion.
And their size helps here.
Absolutely. As they note, their sheer volume, selling tens of thousands of homes, is crucial for effectively running the A/B testing and continuous development needed for a sophisticated system like this. They have so much data to learn from and constantly refine how they find and convert buyers.
Yeah, and they're not stopping there with the tech investments, right? Something about land management.
Correct. Another major initiative is a new technology-driven land management system. They're developing this in cooperation with Palantir,
Palantir, the big data company.
the very same. This aims to create a state-of-the-art high-tech program for the day-to-day administration of land. Everything from the initial identification of a potential parcel through the complex purchasing process, the development phase, and then the just-in-time delivery of finished home sites to their builders.
So it's like a high-tech brain for their entire land acquisition and development process.
That's a great way to think of it, making it much more precise, data-driven, and capital efficient. It aligns perfectly with their whole asset-light strategy, mapping out every single step, using data to make that process incredibly efficient.
And what about their core systems, their back office?
They're tackling that too. There's a massive 2-year undertaking to transition Lennar's entire ERP system. That's their enterprise resource planning system, the central software that runs everything from finance to supply chain.
The plumbing of the company.
Exactly. They're moving it to J.D. Edwards E1. Now, while this sounds like a purely technical, behind-the-scenes shift, it's huge. It will enable a modernization of their entire financial platform, automating processes that were once manual and allowing Lennar to get real-time insights into their massive operation and even report earnings faster. They think they can get down to maybe 10 days after quarter end.
Wow, that's fast. It's all about deep systemic efficiency.
Deep systemic efficiency.
They're also pushing something called a core product strategy, right? Standardizing home designs.
Yes. This refers to a standardized line of homes that now represents about a third of their starts across the country. This product is specifically designed and engineered to maximize efficiency of both the build process and the cost to build.
So simpler, faster, cheaper to build.
That's the idea. It's leading to significant cycle time improvements. They said around 20 days better than their non-core products. And it's being rolled out across all product types and regions.
And they have a goal for inventory turn.
They do. An ambitious North Star goal of achieving 3x inventory turns, maybe even beyond that. And this core product focus plays a meaningful role in hitting that goal. Imagine building the same type of home efficiently across thousands of locations. The savings and speed gains could be massive.
So all this spending on tech, on standardization, how do they justify it, especially now?
Lennar's management views this heavy spending as absolutely necessary. They want to push productivity and efficiencies by orders of magnitude. They explicitly compare it to how companies like Walmart or Home Depot transform themselves through heavy technology investment, even during challenging economic times, to create enduring competitive advantages.
So they see it as foundational.
Absolutely. This commitment, particularly during a softer market where many companies pull back on spending, suggests management's deep conviction in the long-term competitive advantage this holistic technology-enabled platform will create. They're not just managing the cycle, they're trying to build a better machine for the future.
What's truly fascinating here is the sheer scale and integration of the strategy. It's not just about addressing one pain point, like affordability. It's about creating this holistic, technology-enabled platform that touches every single part of their business, how they acquire land, how they market, how they build, how they finance, how they manage the back office. It really is a company betting its future on becoming a high-volume, highly efficient, and incredibly agile home manufacturing machine.
Exactly. It's a fundamental re-engineering of the entire value chain. And doing it now during a softer market, that takes guts. It suggests management's deep conviction that this will set them apart from the competition for decades to come.
Okay, so given all these strategic shifts, this transformation, how does Lennar actually stack up against the competition now? We know it's a fragmented market, over 400,000 home builders out there, many small local guys. But Who are their main rivals?
They're primarily competing with the other national giants, mainly D.R. Horton and Pulte Group.
Right. So how do they compare, say, to D.R. Horton right now?
Well, on the surface, if you just look at the current performance metrics, a direct comparison might initially lead you to conclude that D.R. Horton is the stronger player today.
Oh, why that?
They currently boast higher revenue and earnings,
Yeah.
and they have superior profitability metrics right now, like net margin and return on equity.
Mm.
So, yeah, a superficial analysis might indeed deem D.R. Horton the superior investment at this specific moment based on those numbers.
But there's a but.
There's a but. Lennar currently trades at a more attractive price-to-earnings, PE multiple, than its largest rival, D.R. Horton. That's an important counterpoint, especially for value-oriented investors. Lennar stock is cheaper relative to its earnings.
Okay, so the numbers don't tell the whole story. If we're trying to assess Lennar's long-term conviction, their belief in this big strategy, how else can we look at it?
Our sources point to a very compelling signal: insider ownership.
Management owning stock.
Yeah. But the scale here is astonishing. 10.0% of Lennar's shares are held by company insiders, executives, board members, their families. 10%.
That sounds high. How does it compare?
Compare that to D.R. Horton's mere 0.5%.
0.5% versus 10%. That's a 20-fold difference.
Exactly. And this isn't just a trivial detail. It provides powerful qualitative evidence that Lennar's leadership's personal wealth is profoundly tied to the long-term success of the stock.
Their money is where their mouth is.
Literally. It strongly suggests that the current strategy, despite its painful short-term impact on margins and earnings, is a deliberate, deeply personal plan for long-term value creation. It's personally invested in by those with the most information about the company's inner workings and future prospects. They believe in it enough to bet their own fortunes on it.
That is a powerful signal, and it brings us back to the valuation, doesn't it? You said Lennar looks cheaper.
Precisely. This leads to what appears to be a significant valuation disconnect in the market right now. Lennar's shares currently trade at a PE ratio of around 8 times earnings.
8 times. How does that compare historically for Lennar?
Well, it's not only cheaper than D.R. Horton, but it's also a significant 22% discount to Lennar's own 10-year historical average PE, which is over 10x.
So it's cheap relative to peers and cheap relative to its own history. Why?
The market, it seems, is valuing Lennar by looking in the rearview mirror. It's valuing Lennar based on its historical model as a capital-intensive, cyclical builder. It sees the falling margins and profits, which are a consequence of the current cycle and their deliberate strategy, and penalizes the stock for it.
This really makes you wonder, doesn't it? Is the market missing something big here? Are they focusing too much on the cracks in the facade, those temporary, maybe intentional, lower headline earnings numbers, instead of the newly laid asset-light foundation beneath?
That's the core argument. The stock is being penalized for the temporary pain of the cycle, and perhaps more importantly, for the intentional strategic shift towards volume over margin. But it appears to be failing to award a premium for the dramatically improved risk profile and the enhanced capital efficiency that the asset-light model provides.
So the suggestion is the stock is fundamentally misunderstood by a market fixated on the short term. It's overlooking the profound long-term changes taking place.
That's what the analysis suggests, yes. The high insider ownership, coupled with the strategic pivot itself, indicates that the perceived weakness in Lennar's headline numbers isn't a sign of a business in crisis. It's much more likely an intentional consequence of a long-term strategy being executed with discipline.
So for investors, it's about discerning between that temporary cyclical pain and the permanent structural improvement they're trying to build.
Exactly. It requires looking beyond the quarterly noise and understanding the deeper strategic narrative that management is pursuing and betting on with their own money.
Okay. Now, despite all these strategic advantages, the bold moves, the potential valuation disconnect, the road ahead isn't completely smooth, right? There are acknowledged risks that Lennar and, frankly, the entire industry still has to navigate.
Oh, absolutely. No investment is risk-free. Affordability remains a major concern, number one.
Still affordability.
Always. If housing prices were to increase sharply from here for some reason, or if interest rates remain stubbornly high for an extended period, that average housing payment could simply remain out of reach for too many Americans. That would dampen the underlying demand we talked about earlier, no matter how efficient Lennar gets.
Makes sense. What else?
Then there's integration risk. Lennar recently acquired another builder, Rausch Coleman LLC. That adds about 4,000 new orders a year and brings them into several new markets.
Okay.
Seamlessly integrating a new, large acquisition into Lennar's already highly streamlined, technologically driven business model could present challenges. Will the new operations conform to Lennar's core product and even flow methodologies quickly enough? Or will it cause friction?
Integration is always tricky. What about external factors? Tariffs.
Tariff risk is on the radar. While Lennar reported no significant impact as of June 2025, many electronics components used in modern smart homes come from China. New tariffs could make these purchases more expensive, potentially eating into those profit margins they're trying to protect elsewhere.
Are they doing anything about that?
They said they're proactively working on alternative sourcing, finding suppliers elsewhere, but it remains a watch point.
Okay. And labor. Always a factor in construction.
Huge factor, labor expense.
Mhm.
In a construction-heavy industry, labor is a massive input cost. Any less immigration-friendly federal government policies or just a general tightening of the labor market could increase the cost of both skilled and unskilled labor. That would eat into profit margins for builders across the board, not just Lennar.
Right. And finally, you mentioned something about their cash flow being weird in Q2.
Yeah, there was some atypical cash flow normalization. In Q2 2025, they actually saw a $1 billion cash outflow from home building operations. That definitely raised some eyebrows.
$1 billion outflow. Why?
It was attributed mainly to the lower average sales prices hitting the cash register and also some lingering complex reconciliations from that massive Milrose spinoff, which involved complicated accounting and asset transfers.
So, a temporary blip.
Management expects so. While atypical, they expect it to stabilize back into a strong cash flow environment after perhaps one more quarter, as the spin-off dust fully settles and their asset-light model really kicks in and starts generating cash consistently.
Okay, so risks acknowledged. But despite those, Lennar's outlook sounds pretty confident. How do they frame the investment case now?
Yeah, remarkably confident, actually. And they frame the investment case very clearly. This is not a simplistic bet on a swift overall U.S. housing market recovery that may or may not happen soon.
So it's not just betting on housing.
No. Instead, it's a bet on a supremely well-managed, financially robust, and strategically adroit company. A company that has fundamentally rebuilt its foundation to not only withstand the cycle, but crucially to profit from it. They believe they are shaping their own destiny, regardless of the broader market.
And they're positioned to take share.
Exactly. They feel uniquely positioned for market share consolidation. The current market, with that paralyzed resale segment and the ongoing supply shortage, offers a distinct opportunity for Lennar to consolidate its dominance. Their sheer scale, their integrated capabilities from financing to land management, their tech, their commitment to volume at all, gives them a powerful advantage over smaller, less agile competitors who might be struggling right now.
And that Milrose spinoff is key to the de-risking.
Absolutely key. That audacious pivot to an asset-light model is seen as a game-changing de-risking maneuver. It truly insulates Lennar shareholders from the most catastrophic risks of a housing downturn, those massive land write-downs separating their fate from the whims of land values in a way that wasn't true before.
So just to reiterate those recent weak earnings figures.
Far from being a sign of crisis, they are the predictable result of a disciplined strategy to prioritize production volume and long-term market share. And that strategy is, as we noted, powerfully validated by the immense personal stake held by its own management. They're living the strategy.
So the conclusion is, the market seems fixated on the cracks in the facade,
Those immediate negative numbers.
ignoring the strength of the newly laid asset-light foundation beneath, which, for patient investors, might present a compelling opportunity.
An opportunity to acquire what they believe is becoming a superior, more resilient business at a price that reflects the risks of yesterday, not the profound realities of tomorrow. That's the thesis.
So the road ahead might still be choppy, with interest rates and consumer confidence playing a big role, but it sounds like Lennar is meticulously building a ship designed not just to weather these rough seas, but to actually emerge stronger and potentially more dominant on the other side. It's a truly strategic gamble playing out in real time with billions on the line.
It really is about the long game, isn't it? That emphasis on becoming a manufacturing model with high returns on capital and equity, coupled with strategic growth through land partnerships and technology, it indicates a very deliberate, very forward-looking path. It's a fascinating example of how leadership can try to radically transform a company's core identity and competitive posture rather than just sitting back and waiting for the market cycle to turn in their favor.
Okay, let's try and bring it all home then. Our deep dive today really revealed Lennar's truly strategic pivot to an asset-light model, driven by that groundbreaking Milrose Properties spinoff.
Yeah, a massive structural change.
We saw their bold commitment to prioritizing production volume over short-term margins, accepting that pain for long-term gain,
The even flow
and
model.
their aggressive, really all-in investment in technology to drive long-term efficiencies across every single part of their operation.
Right, the Lennar machine, Palantir, ERP, the whole 9 yards.
It's a powerful reminder, isn't it, that seemingly negative earnings numbers can sometimes mask a deliberate, transformative strategy playing out behind the scenes, one that requires a longer lens, maybe a bit more digging, to truly appreciate.
Absolutely. And this isn't just a story about home building, is it? Understanding Lennar's bold transformation offers valuable lessons that extend far beyond the housing market itself.
How so?
Well, it's a prime example of how large established companies can try to reinvent themselves, how they can strategically transfer risk, and how they can leverage innovation to maintain or even enhance their competitive advantage during challenging economic conditions. It offers a powerful aha moment, I think, on how to look beyond just the surface-level financial reports and truly try to understand a company's underlying strategy and its potential long-term implications.
So here's something for you, our listeners, to consider. Think about this. If one of the nation's largest home builders is fundamentally reinventing itself by shedding land ownership, embracing a manufacturing and just-in-time model, what implications might this have for other capital-intensive industries? Industries currently struggling with market volatility or high asset costs.
Interesting question.
Could we see a broader trend of asset-light revolutions across different sectors? Could other companies look to externalize risk, shed non-core assets, and focus purely on their core operational strengths, leveraging technology like Lennar is?
It's definitely food for thought. What stands out to you from this deep dive into Lennar's strategic reengineering? How might this approach influence other industries you're watching, or maybe even your own thinking about business models and how to navigate challenging markets?
Food for thought indeed. This deep dive into Lennar really shows us that sometimes the biggest opportunities, or at least the most interesting stories, are found precisely where the market sees the most challenges. Thanks for joining us on this deep dive. Until next time, keep learning, keep questioning, and stay well informed.